Let's be honest, who doesn't like the idea of getting paid just for owning a stock? You wake up, check your phone, and Coca-Cola has already deposited a few dollars into your account. No extra work, no selling anything. It just shows up, and that feels pretty good. But then there's the other group, the so-called boring investors, the ones who tell you to stop overcomplicating things, buy the entire market, sit still, and wait for 30 years. That's it. That's their whole strategy. So, which approach is actually right? Today, we are comparing dividend investing and index funds, not just in terms of returns, but also the psychology behind them, real retirement scenarios, and what each one really feels like over time. Welcome to Alex Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. All right. So first, what does it even mean when a company pays a dividend? When you buy stock in a company, you become a part owner. A tiny part, sure, but still. And some companies, usually big established ones, make so much profit that they can't reinvest all of it back into the business efficiently. So instead, they give part of it back to you. That's a dividend. It's real cash that gets deposited straight into your brokerage account. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are classic examples. They've been paying dividends for decades, and some of them have even increased their dividend every single year for more than 25 years. Those are called dividend aristocrats. Now, the number you'll hear most often is something called dividend yield. It's just the annual dividend divided by the stock price. So, if a stock is trading at $100 and pays $4 per year in dividends, that's a 4% yield. Simple. But here's where things get interesting. You don't actually have to pick individual dividend stocks to do this. You can also invest in something called a distribution ETF, which is basically a fund that holds a basket of dividend-paying companies and then pays out regular income to you. So instead of relying on one company, you're getting dividends from dozens, sometimes hundreds, all at once. And just like individual dividend stocks, those payments show up as cash in your account on a regular basis. All right, so what are the actual advantages of dividend investing? The first one is income without selling. In retirement, you're not forced to liquidate shares. You're living off the cash your portfolio generates. That's genuinely powerful, especially during a market downturn. Your portfolio might be down on paper, but if the dividends keep coming, you can stay calm and avoid panic selling. The second advantage is psychological stability. Seeing cash arrive in your account on a regular basis helps people stay invested and avoid making emotional decisions during market crashes. And then there's dividend growth. Strong companies don't just pay dividends, they increase them over time. That means if inflation rises, your income can rise as well, which makes dividends a potential hedge against rising costs. Now, there are also some important downsides. Dividend investing often leads to concentration. Many portfolios end up heavily weighted towards sectors like utilities, consumer staples, financials, or real estate, which means you're not fully exposed to the broader economy and may miss out on higher growth areas. It's also important to understand that dividends are not free money. When a company pays a dividend, the stock price usually drops by roughly the same amount. You're not gaining extra value. You're just receiving part of your investment back in cash. On top of that, dividends are typically taxed when you receive them, even if you reinvest them in a taxable account. This creates friction that slows down compounding, especially when compared to more tax-efficient strategies. And finally, there's the risk of chasing high yields. When people see yields of 7, 8, or 9%, it can look very attractive, but in many cases, that yield reflects underlying risk. The company might be struggling or close to cutting its dividend. And chasing those yields is one of the fastest ways to run into trouble. Now, let's talk about index funds. An index fund is a simple concept. It tracks a market index like the S&P 500, which represents the 500 largest companies in the United States. When you buy into one of these funds, you instantly own a small piece of all those companies, which gives you automatic diversification. The philosophy behind this approach is straightforward and backed by decades of data. Most professional fund managers fail to consistently outperform the market. So instead of trying to pick winners, you simply own the entire market. This idea was popularized by John Bogle, the founder of Vanguard back in the 1970s, and over time the data has strongly supported his approach. So what are the advantages of index funds? The first is diversification. Since an index fund holds many companies, poor performance from one stock has a limited impact on the overall investment. That said, not all index funds are diversified in the same way. For example, the S&P 500 focuses only on the United States, while global index funds spread investments across multiple countries. The best way to understand this is by checking the fund's fact sheet, where you can see allocations by company, sector, and region. Another major advantage is cost. Some index funds charge extremely low fees, sometimes as little as 0.03% per year. In contrast, actively managed funds often charge around 1%, which may seem small but can significantly reduce your returns over the long term. They're also highly tax efficient. Because index funds don't trade frequently, they generate fewer taxable events, allowing your investments to compound more effectively over time. And historically, they've delivered strong returns. The S&P 500, for example, has averaged around 8 to 9% annually over long periods. Although, it's important to remember that past performance doesn't guarantee future results. Now, there are downsides to consider as well. The biggest one is the lack of an income stream. In retirement, your portfolio might have a high value, but to actually fund your lifestyle, you need to sell shares. Doing that during a market downturn can feel uncomfortable and goes against many people's instincts. There's also something called sequence of returns risk. If you retire just before a major market decline and you're selling assets to cover expenses, you may lock in losses at the worst possible time. This is a real and often underestimated risk. And finally, there's the simplicity of the strategy itself. Index investing is by design boring. But staying disciplined with a boring strategy can be surprisingly difficult. When markets drop significantly, there's no steady income to provide reassurance, just declining numbers on a screen. And that's often when investors are tempted to sell at the worst possible moment. Okay, but what does it look like to retire on each plan? Let's say you want to retire with $50,000 a year in income. Let's avoid taxes for simplicity. If you choose to follow the dividend path, you need a portfolio that generates $50,000 in dividends annually. At a 3.5% yield, which is realistic with quality dividend stocks, that means you need roughly $1.4 million invested. Your income arrives automatically. Bad year in the market, it might not matter. The dividends usually keep coming. The real risk of your portfolio is that it is much less diversified, and over 30 years you may have left significant growth on the table. However, if you decide to follow the index fund path, you use what's called the 4% rule. A widely studied withdrawal strategy suggesting you can safely withdraw 4% of your portfolio per year in retirement with a very low chance of running out of money over 30 years. To get $50,000 a year, you would need $1.2 to $5 million. Actually, slightly less than the dividend path. Your portfolio grows faster over time because you're invested in the whole market, but to get that $50,000, you're selling shares. And when markets drop, that feels psychologically brutal. The risk here is the sequence of returns. A bad crash in your first few retirement years can do real damage. That's why people start planning retirement outflows in advance. So, what actually works best? Honestly, it comes down to the strategy you can stick with over the long term. But if I had to choose purely based on the numbers, index funds come out ahead. They offer lower costs, broader diversification, and historically stronger total returns. That's what the data shows. Dividend investing, on the other hand, tends to win on the psychological side. The biggest mistakes don't come from choosing one of these approaches over the other. They come from behavior. Panic selling during downturns, chasing high yields in risky companies, or never investing at all because you're stuck trying to find the perfect strategy. If you found this helpful, you can support the channel by liking the video. It makes a bigger difference than it might seem. And if you'd like to see a deeper dive into topics like dividend reinvestment or the 4% rule, let me know in the comments. Thanks for watching, and I'll see you in the next one. Bye.